What's up, guys? So around 2 months ago, a lot of the market was souring on retailer names. One name that got really beat up was Gap. And part of the reason why they got beat up was because they changed their strategy from wanting to make money to not wanting to make money. And you can take a look at the story of their old CEO, especially take a look at their story of their Old Navy CEO. And yeah, it was just not a good recipe to make money when you're loading up on sizes that the consumer is not actually demanding. So, a good way to not make money in retail is order stuff that people don't want. And so, of course, CEO got let go, and the Old Navy CEO also got let go. And, when that happened, it just said to me that, it's time to reset. Let's start thinking about this. Who are the people that are coming in, and what sort of pedigree do they have to sort of turn this thing around and take it essentially just back to where the company used to be, especially that Old Navy brand. And so, I spoke about it around here. Now, I did not believe that it would run up 80% in 2 months. Not at all. But it's a welcomed run up. And it's another one of those reasons why at least I've been fortunate in 2023 to have the best year that I've had. And, it's all just been these weird one-off types of situations, whether it's the Activision acquisition or if it's this guy or whatever else. It's all just been these one-off things. You don't see any of my portfolio in any of these tech names that everyone talks about on YouTube. In fact, I think my channel would be 10 times bigger if I talked more about, names like Palantir or Nvidia or whatever, but I just don't add any value there. And so, I spoke about it here, and I really said that I'm confident in their new CEO who's able to turn things around. But more so, what sold me on this investment was their new Old Navy CEO, who's a guy who came over from Walmart. And I just felt like if there's any executive that has a really good idea of how to run merchandising for the Old Navy brand, it would be someone coming in from Walmart, since they have run their merchandising strategy in a similar way to Old Navy. And so I just thought that it just all made sense, and it was very likely that this company would not be at $10 per share for much longer. Did I expect it to run up as quickly as it did? No, but sometimes we get lucky on the upside. We've definitely not been lucky on the upside with Alibaba. That's gone the other way, but take your wins where you can get them. And Barron's recently came out with an article where they're saying, hey, one analyst is urging caution because it's still days under their new CEO, Richard Dickson, which is fine, but you have to take that into account with the run-up of the security. And, just in one day, they ran up 31%. So, yeah, the turnaround is happening, but it's very clear that the market has already given them complete credit for the run-up. And so here's what the article goes in to say. So Corey Tarlow of Jefferies said that the positive performance in the quarter for its Old Navy business positioned the company for its turnaround. And that's really what I was looking for. I was looking for Old Navy to go back to what it used to be. And I just didn't see a reason why that wouldn't happen. All you have to do is buy things that people demand. And I understand in retail that's a lot harder than it appears. But at least for Old Navy, you have specific staples that people go there for. Branded t-shirts, jeans. You're pretty much nailed it if you get those two segments of the market correct, or those two items correct. And so, the analyst does go on to say, or I guess Corey goes on to say, that the company's still in the early innings of its turnaround and they remain cautious. I get that, but no conversation about the valuation, right? And so I think that's the most important piece here. And so, he did say that Richard Dickson's previous experience with reinvigorating brands such as Barbie and Hot Wheels will give Gap a head start. And I agree with that. But once again, we got to look at the valuation. And so here's where the model and the tracker comes into play. The first thing I do when these stocks run up is, how is my valuation changing relative to the new news that's coming out? And what is that valuation relative to its current share price? And so this is what I mean. Just using a 12 times or 12 and a half times multiple, you can use 15 times if you want. It's fine, whatever multiple you're comfortable with. I'm valuing the company roughly at its intrinsic value right now. That's how much it's run up. When I was originally buying this thing, it was sub $10, maybe just around $10. So it was very cheap, and it was looking like it was very likely that it'd go into the 8, the 7s, whatever. And so I actually, with this particular name, it's only once in a while where I'll actually have a conversation with my wife and I'll say, listen, I'm going big into this name. I just want you to know. Ultimately it's both of our cash, right? We're a unit here, husband and wife. And so I did speak to her about going very heavy into Gap. I just felt like it was very undervalued in the single digits. And so, we didn't see the potential for this to run up as much as it did. But now that it has run up, my question is, do I see a greater likelihood of this thing continuing to run and go beyond what I believe its intrinsic value is? Like, can it go into the 20s, the 25s? Yes, it absolutely can. But I think that there's a lot of risk here, especially in the face of a slowing consumer. So, here's where, some people get angry at me. They say, you're more of a trader. You're not really a value investor that buys and holds. The challenge is for me is that there's a lot of ideas that I have and not enough capital to service all the ideas. And so what I do is, if any of these securities run up and they run up quickly, I will actually reduce my position in that particular security and reallocate it to a better risk reward profile. And so at least in this case, it's completely matured. I'm comfortable with leaving money on the table. If it goes to 25, totally fine that I don't get that. And I rather put it into something where I see a greater risk reward. And right now in the tracker, there's, I would say, at least 20 names that are trading under 75% of their intrinsic value. And there's a lot of names in that 50 to 60% range. So I would want to be considering some of those. And so overall, this is how I sort of think about it and why I'd probably want to exit the position now, and why I'm likely going to be exiting the position now. Now, one thing that I do want to mention, however, is that, I never expect you guys to take recommendations or anything. I do not make recommendations on my channel at all, but I found that, and I really don't think you should ever take recommendations from anybody on YouTube. I really think you need to do your own research. And that's sort of the audience that I cultivate here. It's teaching a man to fish as opposed to just giving you the fish type of thing, right? And the one thing that I do want to point out is that you have real superstars at Gap right now. And this is what I'm talking about. The Old Navy brand is run by Mauricio Barbito. Correct me if I got that wrong, but I just think this guy's a phenomenal superstar. He was the former CEO of Walmart Canada. He's worked all over the world. I've seen him in a documentary as well. I believe it was him. I might be wrong. But so you can see it right here. Prior to joining Old Navy, he spent 26 years with Walmart, including a decade in CEO roles for Walmart's various international businesses. And it was where he led Walmart's $22 billion Canadian business and the team's 100,000 associates. And I just think that if you're looking for a pedigree of a guy who can turn around Old Navy, but not just turn around, make it a more global brand than it currently is, then this is the guy who's going to take you there. So can this security go higher than 20s into even the 30s? Absolutely. So if you're willing to wait, I think that this could very well happen. Obviously, that's not a promise. That's not a recommendation, none of that stuff. But I just think that you got these heavy hitters over at Gap. But there's also risk, right? And I put this in the model for Gap. I'll continue to follow this story just because I love the fact that they've been able to turn this around. And I'm really cheering for their success. I want all of the Gap shareholders to continue to do well. And, I put this warning anytime I have a model where, basically whenever you build a model, you're taking a position one way or another, right? And generally, if your model is saying that this company is worth way more than what the current share price is, you're basically saying that the entire stock market is wrong and you are right. So you better be right, or at least understand why your valuation is different than the entire stock market. So you kind of have to understand where they're coming from as well. And so I put this warning here and I said the valuation only works if the Gap can bring down their other operating expenses and maintain their gross margins. So gross margins of 37%, which it's not easy to do in the face of a slowing consumer. And then the other part of it is maintaining your operating expense costs in the face of inflation, especially wage inflation, which is something that they have to deal with. And so the only way you can really do that is keep prices strong, which is not an easy thing to do in the face of a slowing consumer. So with retail, this can turn very quickly, and you see how low the operating profit margins are. So you can go from a very good operating profit margin to negative operating profit margins very quickly. This is why retail is a very tough business, especially retail with the strategy of like an Old Navy. I understand that the whole brand is an Old Navy, but that's just a big piece of it. And so this is why I believe that you can mess this up. Not necessarily mess it up, but I think economics can play a big factor here. And so I believe that it's more likely than not that you hit a bump on the road and things go the other way and the security price could potentially follow as well. And so why not just take it off the table now? Maybe at least take most of it off the table right now. So that's the direction that I'm going. And once again, there's a lot of potential opportunities in the tracker that I can redeploy this into. The first one that comes just off the top of my head is Foot Locker has not had the same run as Old Navy has. And maybe that might be a place to reallocate capital. I'm a huge fan of Mary Dillon. Another name that's on the tracker that seems a little cheaper, obviously won't run at the same level as any of these names, would be probably like a Sprouts. And you guys can take a look at the Sprouts model in the tracker as well. I love that company. And once again, that is staffed by former Walmart people as well. So, these Walmart alumni are absolutely crushing it. And if you don't have access to the tracker, I make it super easy. The whole point isn't really to make money off you guys. It's more to show you guys how these models are built. And then I give you access to a free a blank model, which you can start building your own models on top of. And so that's all available to you at that $5 a month level. And if you want to join us for an epic live presentation every month, you can join us at that $15 a month level. And there's almost, I'd say, close to 200 Patreons that are in one of these two categories. And so there's quite a bit of us that are here. And so I really hope that you consider joining us. But the other question I would ask is, where do you feel the Gap's valuation is now? Should it be valued in the 30s, 40s? Let me know in the comments below. I'll respond to all of you guys. All right, take care now.